Yeah.
Yeah, I told you I have.
You've shared it.
Yeah, I
Okay.
replied you that I said, yes, I have.
Hi everyone, good afternoon. Hi Bumi, great to have you here.
Hi, good afternoon. Confirm you can hear me.
Yeah, I can hear you. So can we start now?
All right. I think we can. Considering we're using StreamYard, do we have any idea of how many people we're working with today?
Yes, so it's going to display, although from my own part, yeah, so it's going to display, but we'll tell them to make an introduction as soon as they are joining. So you see their name, their startup name in the comment section. So hi everyone. So if you are just joining in, please let us know your name and your startup name and your location in the comment section so that the speaker can effectively communicate with you guys. So just give us your name, your startup name, what you're working on, so the speaker has an idea of those here. So those just joining in, I believe you can hear me. I'll type in this, just your name, your startup name and location. That's all, so that the speaker can communicate with you guys. So without wasting much of our time, 6 minutes already gone. So we'll be introducing um, our facilitator for today in the person of Oluwabumi Balogun. Bumi is a growth marketing professional successful in campaign development and program management. He is a proven growth expert who has successfully built brands from 0 to 10x within a short period of time. He has helped in building million-dollar businesses as a growth marketing expert. He has also successfully acquired digital leads for businesses up to the tune of 14 billion naira and acquired up to 200,000 plus users for businesses across Africa. Please join me in welcoming Oluwabumi Balogun. Thank you for accepting to speak today, Bumi. So you have the room now. So guys, if you are just joining, drop your name and startup name so that the speaker will be able to communicate with you guys. Thank you.
All right. Thank you very much. I see we have people all the way from South Africa. Thank you very much for that. All right. So I'll just go right into it. Trade Hunt South Africa. Thank you. I'll go right into it. Today we're going to be talking about growth and scaling for startups. Right. Everybody in this room is a founder and the owner of a company. Is a startup. And at some point, I want to believe that you have the desire for your startup to be able to properly grow and scale. You do not want to play it small. I was recently listening to um, a particular tweet. Someone tweeted, I won't mention names, but the particular tweet I saw, I think I saw that yesterday or the day before. And that tweet read that he was talking about fintechs in Africa. And he said that there's quite a lot of fintechs in Africa already, that almost everybody is doing the same thing. However, the only way for companies to stand out nowadays is if they have deep pockets and they can be able to scale. I won't mention who made that tweet. He said the only way fintechs that are coming up now will be able to succeed is if they have deep pockets and if they know how to scale. So I believe we all know what deep pocket means. It means you have some bit of funding, you have investments. I'm sure part of the benefits of this program that are part of is to know how to raise funding and how to make investments. Right. Successfully, one of my I run a startup called Pocket Food, and beyond Pocket Food, I also have a couple of other startups that I mentor and consult for. So one of the startups that I'm actively involved in yesterday, Pocket Food, we just announced that we got funded. We just got $100,000 in funding. And when we made the announcement, it was quite interesting because the announcement started bringing in a bit of people that were now looking for partnerships with us, right? So I believe that's what the meaning of you need to have deep pockets. We're not a fintech, anyways. We're in the food and logistics space, but that just proves to you that as a founder, there's a need for these two things: funding and growth and scaling. Now, what then is growth? The term growth marketing, it has become a buzzword for a lot of people of late. A lot of companies, a lot of people, you see them on LinkedIn, on social media when having conversations. They say they are growth marketers, right? Growth marketing has become a buzz keyword when looking for careers in the digital space, either as individuals or as talents. However, the buzzword is the fact that a lot of founders still struggle to create KPIs and track return on investment when employing growth marketers. Um, I have a couple of examples that I want to give, right? I know a particular company that was trying to look for growth marketers, the fintech. And when they eventually reached out to me to help them um, get within my network and see if I can recommend a growth marketer, I did. Only for me to find out when the person joined the company that they really did not know what they wanted the person to do. The person started doing a lot of things from sales to business development. It was just a lot. The young man became quite confused at some point and he decided to leave. He resigned from that company. And that's some of the things you see today. A lot of startups struggle to understand what exactly is the term growth marketing and why do you need a growth marketer and why do you need to be focused on growth. So growth marketing is a data driven and customer focused approach to marketing. So it helps you identify ways that you can scale by acquiring and retaining your customers. Two key things: acquire and retain. That's the definition of what it means to scale and grow. How you acquire your customers, how you retain your customers. At the same time, you want to ensure that you are doing these two things in the most effective way. Now, growth marketing involves continuously experimenting, right? You're experimenting with different strategies, different tactics. At the end of the day, you want to pick one or two ideas that would help you scale and scale successfully as a startup. The goal of growth marketing is to drive sustainability and scalability and scalable growth for businesses. Growth marketing is different from your average traditional marketing, right? And that's because growth marketing largely focuses on data, experimentation, and iteration. So, iteration in this case means continuously repeating or continuously trying out different hacks or different processes at the end of the day to drive growth. And now, a lot of people confuse this particular thing with um, social media managers or digital marketers. While all of that might be some of the things you need to grow as a founder or as a startup founder, it's not the core thing of concept of growth marketing, right? The goal is we want to allow the use of data, we want to allow the use of experimentation to be able to drive growth for companies, and it involves a lot. But the goal is data, 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 data. And as a founder, I know a lot of us here today are early stage founders. But one of the biggest advice I'm going to give to you as an early stage founder is to start gathering enough data. Start gathering enough data from this early stage. I was opportune to be in a meeting room about 3 weeks ago, and this was a room with some international founders, investors. They wanted to invest in a startup here in Nigeria. I won't mention the name again. It's a very, very big startup, like very, very big. I can't mention the name and you won't know about it. Very huge company. So they wanted to invest in this startup. They were already doing their valuation for the startup. They were already valuing the startup at 200 million, $300 million as valuation. Now it was time for them to make their investment. And one of the key things they asked the owners of this company for was their data bank. They wanted to see the number, their data from when the company started up till now, customer growth, iteration, different experiments they've been running, how they've acquired users, their different acquisition strategy. They needed that data bank to validate that yes, okay, this company is really worth $200 million before funding. Interestingly, the founder said they do not have enough data. And again, like I said, this is a company that if I mention the name, everybody knows. Even I was surprised that these guys, you don't have it to prove that you're actually as big as you say you are. Right? And it was quite interesting. They lost that investment because there was no data to back any of their claims. So from this early stage as founders, you need to start paying attention to the amount of data you're gathering. It's going to help you scale. It's going to help you even raise funds in the future when you want to do so. Now, what is scaling? Scaling is when your revenue increases without substantial increase in resources. What are substantial increase in resources? You want to increase your amount of revenue, and you decide to say, okay, sometime in September, we were making 1 million naira every month, for instance, an example. And that 1 million naira we're making, for us to make that money, we're spending 100,000. So we're spending 100,000 naira to make 1 million. And now you say you want to scale to 2 million from 1 million. And then the advice that comes up is okay, if we're spending 100,000 to make 1 million, and now we want to make 2 million, let's spend 200,000. That's not scaling. Because, like I said, scaling is you're increasing your revenue without a substantial increase in resources. Meaning, even if you want to increase the resources, you're only increasing it by a very little amount, but your revenue is increasing largely. Processes that scale are those that can be done in mass without extra effort. Processes that scale are those that can be done in mass without extra effort. For instance, if I send an email to 10 people or 1 million people, it's still the same effort. If I have a emailing tool, if I have an emailing tool like MailChimp, it's still the same thing. All I just need to do is, if the previous one I had 10 contacts, now I just need to upload 1 million contacts on my MailChimp, and I'll send my email. I've just scaled from sending mail to from 10 people to sending mail to 1 million people without necessarily increasing the amount of resources I'm going to incur to a very huge amount. Now, I'm not saying that resources will not increase at all. I'm not saying it's zero increase, but the amount should be substantial enough. Very little and considerate amount of resources to increase your revenue. Biggest problem, however, is that it takes a lot of resources to sustain constant growth. Because of the cost associated with growth, modern founders have become obsessed with the ideas of scaling. The key difference with growth is that scalability is achieved by increasing revenue without incurring significant costs. This is what I explained before. While adding customers and revenue up exponentially, costs should only increase incrementally, if at all. I'll give an example with my company, Pocket Food. So we were at an investor's pitch a couple of months ago. We had some of the representatives from Lagos State government and some other top investors from out of Africa. And they asked us, how do you intend to scale? Right? And we started giving some explanation on how we want to scale, how we want to do this one and do that one. And one of the questions this investor asked us was, if you're doing this, it means you need to employ more people. Am I correct? I said yes. It means you need to get new offices. Are we correct? I said yes. And the feedback from this investor was, well, you're not scaling because you're incurring higher costs for you to get this new market you're talking about. You're getting more staffs, you're increasing your office space, you're employing more people, you're spending more on marketing. So how then is that scalability if you're doing this high amount of costs just because you want to increase your revenue? And that was a very, very strong feedback we had to take back to our company at Pocket Food to rework our whole strategy to see how we could scale without incurring significant costs. At this critical stage, the business will decide between growing at a regular rate or switching over to faster company scaling. Right? The difference that's talking about the difference between growth and scaling. Now let's go into some of the key things you need to monitor when you're talking about growth. And this is for all of our founders in here. If you've not started doing this, you need to start looking at these metrics now and start measuring it. First, you need to start measuring your monthly recurring revenue. On a month-to-month, how much are you doing in your revenue? This particular metric is very, very important when you're speaking to any investor, when you're speaking to any business owner, when you're trying to work around your scalability. How well are you doing on month-to-month? If your month-to-month growth rate is not good enough, then it means it's not yet time for you to scale. You have to keep building. But if you've seen your month-on-month recurring revenue, your monthly recurring revenue, and it's already looking very, very good, the numbers are looking good, you're already profitable, you're already doing numbers that can sustain you for every month as the new month comes in, then you can start thinking of scalability. Second thing you need to look at is your CAC, your customer acquisition costs. How much is it costing you to acquire a new customer? You're adding how much you're spending on marketing, how much you're spending on your sales, all of these expenses put together, you need to know how much it costs you to acquire a new customer. If you're spending over $1 at the moment, and it's even way lesser. I was listening to a pitch this morning. One of my startups that I'm a part of is a fintech. They're called Wallex, WALLX. So I'm one of the co-owners of Wallex, but I'm not actively involved in Wallex today. So the two guys that are actively driving it, they're currently in Canada. The company got into 500 Global Accelerator. So today was their demo day, very early this morning around 1 a.m. Nigeria and Canada time. So I was listening to the pitch of somebody else in that accelerator program, and he said he spends $1 to acquire 47 customers. I'll take that again. He spends $1 to acquire 47 customers, which means if I'm doing the conversion, he spends just about 950 naira to 1,000 naira for 47 customers. Now, I do not believe that's true. Anyways, I think maybe he's just trying to bloat his numbers. But it was quite impressive to see that there might be a possibility in that level of customer acquisition. Such person, if he's actually doing that, it means he can acquire way more customers with very little amount of money. So he can start thinking about scalability. The third thing we want to talk about is NPS. I'm not going to disturb us with this, right? But it simply means how possible is it for somebody to recommend your product to another person? If your NPS score is not good, if somebody else cannot recommend you to another person, then you should not be thinking of scalability because it means you've not gotten your market properly. It's when you've been able to get your market properly that you can say, yes, wherever I'm scaling to, I'm going to be recommended to by other people. Number four is your retention rates. What's the percentage of time customers keep coming back to your product? Do they just use your product once and after that first time of using the product, they are not impressed anymore? They go. Or the product is so interesting that they keep, if it's a subscription based product, they keep subscribing every time and every time because they're enjoying the services you're offering. And then the last one is the viral coefficient. Similar to the Not Promoter Score, right? He's talking about how well new customers are acquired by simple word of mouth or referrals. So this is just similar to the Net Promoter Score. So these five key metrics, as a founder, is very, very important for you if you want to scale. You need to start recording these metrics from now. Now, what are you might think that reaching hyper growth status puts you on the inevitable path to success, but it appears not. Statistics have shown that two-thirds of the fast growing companies fail. That's another thing you need to take note of. Yes, you want to grow, you want to grow, you want to grow. But are you growing properly? Are you growing step by step, or you just want to grow immediately and grow properly? I'll give another example. My company, again, I'm going to be giving a lot of examples on this call. So let's just try to follow me. Pocket Food again. We recently acquired another company. Recently acquired a company called Balance Bowl. Now, Balance Bowl, when we acquired them, as we had access to their data room, we found out that they had customers in Nigeria and in Liberia. In fact, they had about 180 customers in Liberia that they were servicing. Now, top of our head, we were already thinking, 180 people already in Liberia. Let's go and open shop in Liberia so we can continue serving these people. But one of our mentors met us and said, why? Why do you just want to quickly scale? Just because you've seen 180 potential people, you just want to quickly scale. Are you sure you're properly positioned for scalability? We have to go back and look at it, and that's true. Statistics have shown that companies that two-thirds of the fastest growing companies fail quickly because they just, without checking proper KPI metrics, they just want to start growing immediately. And at the end of the day, it leads them to faster failing. Other macro studies have shown that slow growing companies tend to do better in the long run than their faster growing counterparts. This is not to suggest that you shouldn't want to grow quickly, but you need to do it smartly. You need to be one of the good ones. Very, very important. Now, what are some of the challenges people face when it comes to scaling, right? One is you need investment. I've already said this over and over again. Investment is very important, right? You cannot scale if you don't have some bit of funding. So you need to learn how to raise funds as a startup. You need to learn how to get investment from VCs and accelerators. Two, typical scale-ups have products that scale well. So a lot of companies today, yes, they might have a product that can help them scale, but their processes are not designed to scale. I'm going to explain this down the slide when we get to some point. Yes, you have a product that you can scale to other countries. Amazing. You can scale to other markets. Amazing. But your process internally as a company, you've not properly managed it. I was listening to a video one day, and someone was saying that if you walk into any KFC store, no matter where it is in the world, it's always the same. If you walk into any McDonald's store or any Burger King store, no matter where it is in the world, it's always the same. The taste is always the same. The customer service is always similar. Everything is always the same, no matter where the store is in the world. And that's because these companies have been able to set up processes that can scale no matter the country they get into. You will not need to go to Canada and taste the Burger King and be like, no, the Burger King in Canada is sweeter than the Burger King in the US. You don't need to go to UK and say, no, the McDonald's in the UK is better than the McDonald's in the US. It's the same thing, regardless of whatever market that they are. And that means they've been able to drive internal process that is designed to scale. And that leads to the third point, company culture. The culture of your company, is it the same thing across board? If you employ 10 staffs today and you employ 100 staffs tomorrow, will the culture be the same? Or maybe because you now have 100 staffs, it's now more difficult to manage them. The whole culture now goes bad. It's not easy to manage. HR processes are not working. A lot of things are not working anymore because you've increased your team. So you need to start embedding a company culture from now so that when it comes to growth and scaling, that culture would remain at the end of the day for the company. Now, this is the last part of my conversation, which is strategies used in growing and scaling. But before I even talk about this, I want to first get the feel of the room. Have we been following so far? I want to see your comments. Have we been following so far? Any feedback on the chat? What has been your thoughts so far for the last 30 minutes that I've been talking? Have you been following me? I want to see the feedback on the chat before we go into the last phase of this conversation. I'm looking forward to our responses on the chat. I'm looking forward to our responses on the chat. Have you been following? Do we have any
Hi,
questions?
Bumi. Deborah here. I'm supporting Pascal. I'm from Inspire. There are some questions here, and maybe at the end of the session you can take them. I can see how does a startup know when to scale? Does a startup founder record metric when the startup is fully launched, or can founders start to? I mean, there are questions there that we can get to at the end of the session, if that's okay.
Okay, awesome. I couldn't
All
see
right,
them.
thank you.
Okay, I think I
Okay,
can see the comments now.
you can see them now. Okay, or if you can't see them, I can read them out to you.
I can see them. I think I'll just take all of them
Okay.
at the end of my session.
Okay,
Awesome,
perfect.
awesome.
Thank
I
you.
see a trade hunt from South Africa. I see um, Onaya from Abuja. I see Fred, Fresh Fish Ghana. Awesome, awesome, awesome. All right, we're going to come to these questions at the end of the session. So now, what then are the key strategies for growth and scalability? Right, that's where we are now. What are the key strategies for growth and scalability? Now, there are four major strategies for growth for any startup. Four major strategies. One is market penetration, two is product development, three is market development, and four is diversification. Market penetration, product development, market development, and diversification. This matrix is called the Ansoff matrix, and it's used to identify a potential organization or a brand that is ready to grow. It helps you understand as a business owner your current system and analyze the risks associated with developing a new growth plan. Now, let's go into the first one, market penetration. This is the easiest and the lowest risk strategy. Now, what does this mean? A company using market penetration will attempt to expand the sales volume of its current product in an already established market to increase its total market share. Let me give an example. I wrote something here called the Pocket Food Ambassadors. So when we were building Pocket Food in the early stage, a lot of the sales was done by the internal team, and then we had a few salespeople. But one of these days, we thought of an idea, right? I thought of an idea, and I said, Pocket Food, what we do basically is we provide healthy meals to professionals in their offices. If you want to eat good food, All you need to do is go on our platform and subscribe for a meal plan. So we don't do instant daily delivery or instant request of meals. No, you have to create your own meal plan per week. Monday I want to eat this, Tuesday I want to eat this, Wednesday I want to eat this. So you create like your weekly meal plan, and then once you've done that, you now connect your request to an independent chef. So there are chefs sitting on the back end of Pocket Food that will receive the request. Any chef that can make that kind of meal will accept the request, and then every day they'll be making that meal for you and be delivering to your office. Now, considering that we're looking at penetrating into offices, we came up with an idea called the Pocket Food Ambassador. What we did was we looked for about 20 companies in Lagos, Nigeria today that have good amount of employees in their office. Now, we might not have contact with the CEO or know the CEO or have access to the CEO or the HR, but it's possible that we might know somebody that works there, right? So we look for 20 companies that we know people work there, people within our contacts. We know that, yes, I have a friend that works in this company, I have a friend that works in this company. And then we spoke to each of these friends and we said, we want you to be our ambassador in your company, meaning we'll be sending free meals to you personally. But what we want you to do is recommend to your colleagues, to your founders, your CEO, for them to start using Pocket Food. It was that simple. It was that simple. Free meals will give to you. All you need to do is once you're eating your free meal, tell people that hey, it's Pocket Food, or you guys should go and order your own. Tell your HR, hey, I'm not eating from Pocket Food, or you guys should check it out in this office. And I can tell you, out of the 20 companies that we outlined and started this program, 16 of our ambassadors became successful in this particular field. It increased our sales volume largely. And we did not have to start going to those companies to book appointments with the owner or to look for meetings with the owner or trying to start driving sales conversation with the owner for them to come and use us. We know one company alone that gave us about 200 staffs, just one company, by simply just knowing one friend that works there. The friend just spoke to the HR just agreed. Immediately it became their official office meal delivery platform. That is market penetration. Market penetration encourages brand loyalty and customer retention by using marketing materials to engage customers with your current product. You can achieve this through price reduction, bundles that lure customers away from their competitors, or create higher quality creative content that generates more leads. This is the first way to, or one of the easiest ways for you to grow and scale as a company by expanding your sales volume, creating more strategies that would increase more people to come in, for more people to be loyal to the brand. And you see the Pocket Food example I gave. All we needed to do is give free food, and we scaled our sales volume largely, which goes back to the initial point I said was with scalability is increasing your revenue and your market with very substantial or little amount of resources. So we did not need to employ salespeople and be paying them salaries every month. We just got a friend that we can give free food, cheap. And that friend is giving us 200 of their colleagues in the office. That friend is giving us 15 of their colleagues in the office. Scalability, increasing revenue with substantial increase in your resources. The second way of scaling is through market development. Now, this is a high risk strategy, but it can yield high returns. And you should only consider this strategy when you have enough capital and resources. Market development is about expanding or retargeting. To create a market development strategy, you need to conduct extensive market research to identify market segments, small batches of people, and all of that. Now, I'll explain this again with another example. At Pocket Food, like I said, we're focused on giving corporate professionals and offices healthy meals. But one of our advisors said to us, why don't you guys work with students? Why don't you give students meals too? Immediately she shared that idea. All of us said, no, students don't have money. Students, they cook their food by themselves. Students will not be willing to pay for food. compared to a corporate person that is busy 9 to 5. Student has some bit of time. She can go to class and come back. She can go to class and come back, and she'll cook her food. She doesn't want. But this person said, no, try it. So we went to one of the schools in Nigeria, and we did a free sample of meals for some students. Just did a bit of awareness around that student environment to get if we can see interested students. And I kid you not, we saw students that are in school and they pay heavily to get food delivered to them. What we've just done is we found out an entirely new market that we can start selling to. Again, little amount of resources incurred. All we needed to do was do tests around the environment, ask questions to students, give them our meals for them to taste. And we saw students that were willing to pay heavy. And today, I particularly know one particular student that we deliver a lot of about 3 or 4 packs per day just to her. She spends enough money eating. And her reason is that she's an ESCO in her department, right? She's in politics in the school. So after going to classes, coming back, trying to do her political stuff inside the school, she doesn't have time to cook. And she now uses pocket food. So you're attracting new customers and markets by finding further uses of your product. So we have initially started our product and saw that it was fit for corporate people. But now we've further seen that even students can benefit from this product. This is called market development. You're scaling into an entirely different market. Market penetration is your market that you're currently serving. You're just expanding how you sell to them by increasing the customer's interest and retention. Market development is you found out a whole new segment of market that you can reach out to. You've done your research and you start selling to them. The third one is product development. Now, this focuses on creating a whole new product entirely to increase your market share. I'll give an example, Flutterwave. Flutterwave simply started as a payment solution for businesses. But today, for the sake of scalability, Flutterwave has expanded. There's Flutterwave Swap, where you can swap currency, international currencies, if you're moving countries. There's Disha by Flutterwave for creatives, where you can go ahead and upload your products. If you're a creative, you have something that you sell online, go ahead and upload it like their own e-commerce store. So they are developing different products so that they can increase their share of the market. Imagine somebody who owns a restaurant that sells desserts, and all of a sudden, after serving only ice cream, you decide, okay, let me add something else to my ice cream. Let me start selling waffles, so that people that like waffles can come. Maybe before, there's somebody that was not coming to your store because he doesn't like ice cream, but he now hears that you've added a new product, waffle. He now starts coming to your store. Now, this particular one is also a high risk strategy, because you need to be sure that you're building a product that people want. It's one thing to have products, another thing for people to be interested in it. You might today be a payment solution, and you now say because you want to increase your revenue, instead of being a payment solution anymore, you start adding payment, you start adding e-commerce, you start adding unnecessary products that or features that people are not interested in. You fail. So product development requires a solid collaboration between the teams to be successful. The product team and the marketing team. The marketing team has to have gone to do proper research to be sure that, hey, we're selling this thing, but yes, we've seen that people are now asking for this other thing. Can we add it as one of our products? Now, when the product team goes ahead to add it, the marketing team goes back to change their messaging to say, hey, we're now doing A and B. So if you're not interested in A, you can be interested in B. Or you can do both A and B together for more money. Now, the fourth option is diversification. Diversification is saying, I want to do something entirely different. This is the highest risk growth and scaling strategy. I'm in a payment solution, and This is very high risky because you're implementing a whole new strategy. For instance, you're a founder of a fintech, just like me. I remember I said I own a fintech today. They're even in Canada. And I decided to also go and start another business, a food business with somebody. Because of the risk involved, I had to step down from the fintech. Even though my equity is still in the company, I'm no longer working for them. I no longer get salaries. I no longer get paid. I'm no longer an employee of the company. I'm just a backbencher that owns equity in the company. And now I'm focused on building a food tech company. So that's diversification. And what most people do is the way they diversify is they will have one parent company, say A and B Consulting. Now, A and B Consulting will now have a fintech product. A and B Consulting will have a fintech food product. A and B Consulting will have a HRO solution. A and B Consulting will have a farm. See that these are entirely different markets: fintech, food, HRO, farm. So, but all of these companies will now be under one entity called A and B Solution. This is what you call diversification. Building a lot of products, entering different industries all at the same time, trying to ensure that you scale and grow the company. So the difference between this and the product development is saying in that product that I already have, I'm just adding something new to it. In my fintech, that is a payment solution, I'm just adding an e-commerce store to it. But this one is saying, even though I have a fintech company, I also want to have a farm. So I'm building an entirely different farm company with a different name, but they are all under one umbrella. So these are the four different ways, or the four key ways any founder wants to scale should be looking at. The easiest, like I mentioned, is your market penetration, coming up with ideas for you to still continue to expand your sales volume, but with the same product. You have your market development. You're looking at another segment of the market that you can still serve the same product. You have your product development. You're saying, okay, I want to add another new feature to my product because I think that new feature is what people are interested in too. And then you have your diversification that is saying, I want to build an entirely different company or an entirely different product and enter a whole different industry. These are the four key things when it comes to growth and scaling for startups. And like I said, remember those metrics that you must pay attention to for you to be able to be successful. Again, my name is Bumi Balogun. I've helped startups raise a combined value of over $300,000. I've helped two startups get into tech stars. I've helped two startups get into the Barbara Network and other global accelerators. I was inducted as a mentor of one of the biggest accelerators in the world called Startup Bootcamp. This is my LinkedIn. You can go ahead and check for me on LinkedIn, connect with me, and I'm very, very open to respond to you at any time. Thank you very much, everyone. And I think we'll just head over to the question and answer segment. Thank you.
Thank you so much, Bumi. That was really insightful. Can you see the comment on your side? There are a couple of
Yes.
questions.
All right.
Okay. So you can just begin to take them and answer them. Thank you.
All right. So, Mary, how does a startup know when to scale? I don't know if I've been able to answer this question based on the feedback that I've given, but four different ways to scale. Second question, if I've not, please let me know. Second question says, the startup founder record metrics when the startup is fully launched, or can founders start to record metrics when building a waitlist? Please start recording your metrics from your product development and waitlist stage. For your waitlist, I want to believe you're already acquiring people at the back end. So you need to start recording your cost per acquisition, right? You need to start measuring your cost per acquisition from that beginning stage. What's it costing you to acquire these users? Their interests. These users, are they even open to want to refer another person, even though they're on the wait list? So you need to start from the very beginning of your building stage. Promise it. How do you measure the metrics? So there are certain tools to use. Um, I think maybe I'm not sure if this is one of the sessions you've had. There are a lot of analytics tools to use help track your KPIs. Google Analytics. Um, there are a whole lot of them, right? They're not coming to my head right now. You have um, Google Analytics, you have yeah, they're not coming to my head right now, but there are a lot of these tools that you can use, right? So once you have them implemented on your platform, they immediately start tracking these KPIs for you from the very beginning, right? Okay, so let me head on to. I think before I leave this call, I'm going to make sure I get names of some other tools. Let me just open my computer to look at some of the tools I use personally. Maybe that would help. Um, yeah, so Google Analytics, Metabase, Adjust. These are some of the key tools me I use personally. Google Analytics, Metabase, and Adjust. So you can try any of those. Yeah, my slide, I'll send it to the team so they can forward to you. Thank you, Stephen David. Said your thoughts on scaling are marvelous. Thanks. Okay, Fred Assem said, any advice on getting it right from the onset since I'm still in the ideation stage? All right. Yes. Before building, one of the advice I'll give you is before building, if you're in the ideation stage, validate your ideas. Today, I know startups that have raised fund. Is in short, a friend of mine just raised $100,000 from just an idea. But how did he raise that money? He validated the idea. People had already started, and that's the one of the things somebody mentioned on the chat, the wait lists. And you don't need to build your pocket food that I'm mentioning today, right? Pocket food started out as a simple jot form, Google jot form. That's what we started at. We just created a jot form and started sending to people. Ask them if they were interested in creating meal plans, and then we'll have chefs cook it for them. Those that said yes, we sent them another form for them to go ahead and start creating meal plans. Till today, Pocket Food is already over 1 year, over 12 months, 13 months as at 14 months as at now. That jot form is still existing. People are still using that jot form. And we already have a mobile application as I'm speaking. So validate your idea. Simply use your idea, reach out to people, create simple forms, get feedback. Even with those feedback, you can even take those feedback to investors and say, hey, I thought about this idea. Um, so far, 100 people have said they like it and they're interested, but I need money to build it. You see early stage investors that will give you money to build it. So that would be my advice for you. Um, Validate your ideas first with customers, even before looking for partnership. Right? Get people to be interested, to be vested, to um, buy into your idea. And then the next step to partnership we'll be looking for is product development partnership. Look for people that will be open to building this product with you. You don't need to pay an arm and a leg. There are people today that don't mind coming in to partner with companies to help them build their products, right? And like I said, the slide will be shared to the team so that they can share with you as well. I would like to know your thoughts on how companies that handle return between who covers the logistic cost. Okay. I'm not sure I understand your question, Mary Katambi. I'd like to know your thoughts on companies how handle return between buyer and seller. Who covered? Okay, I'm not sure I get you, but I'll just give an example, rough idea. For us at Pocket Food, the buyer covers his logistics costs, right? However, we subsidize this to a very good rate, so you're not paying an arm and a leg for logistics, but simply the buyer. Now, if you as a company or a seller, you want to be covering your logistics costs, you need to be careful so you don't run at a loss. Now, the other way most people do it is in order to play to the psychology of people. Let's say the product is 10,000. They'll tell you that the product is 12,000, and then they'll tell you that logistics is free. But you'll not know that you've actually already paid 2,000 naira for your logistics by yourself. They'll just give you a round figure saying, hey, this thing you want to buy is 12,000. Are you okay with it? If you say yes, go ahead. When in actual fact, that thing was actually 10,000. But the 2,000 they added on top was the logistics cost. Right. So I hope that answers your question. Thank you, Ayomide. Thank you so much, Mary. So I think I've answered all of the questions that I see on the chat. Thank you.
Thank you so much, Bumi. So another minute to share any questions that you may have. Also, if you can fill out the attendance sheet, the link is on the screen. I'll just wait if anyone has any question. And Bumi, like you said, you would share your slides and would share it with the team, with everyone else, just so you can have more information. Any more questions, please? Right. Fred just sent in a question. He said, please, did you say you started with a jot form? If yes, can you share how to get such a form?
All right. Yeah. So you can just go on Google and type dot form. JOTFORM. JOTFORM. Dot form. You can just go on Google and type it. It's a free form. It allows you to build form that you can send out to people for them to fill. So just go on Google and type that JOTFORM dot form, and you can have that set up Fred.
All right. Thank you so much, Bumi. So in the absence of any other questions, we'll close the session. Please don't forget to fill out the attendance sheet. And I just want to say thank you so much, Bumi, for taking our time to share insight and knowledge with us. It was really interesting. I learned so much myself. Thank you so much. And yes, we'll just close out the session now. Thank you.
All right. Thank you. Thank you, everyone.